Hello and welcome to AI Market News by LM. Well, what a weekend. A major geopolitical event has just sent massive shockwaves through the global markets. And it's raising some urgent questions about the price of oil. We're talking about US-Israel strikes on Iran that have created an incredibly volatile situation. Right now, the entire world is basically holding its breath to see what happens next. And this brings us to the big one, the question that's on every single investor's mind. It directly links this conflict to its biggest potential economic impact. Is that nightmare scenario of $100 per barrel oil officially back on the table? So what exactly caused all this turmoil? It all happened so fast. President Trump confirmed the military campaign against Iran will continue, and almost immediately, we saw the effective closure of the critical Strait of Hormuz. And just to put that into perspective for us, that one narrow waterway handles about 20% of the entire world's oil supply. With Iran now retaliating against US allies, the whole region has just been thrown into chaos. Okay, let's dive into the market reaction, because the most direct consequence of this conflict was seen in the absolutely staggering opening of the oil markets on Monday morning. To really get a sense of the whiplash, let's just rewind to Friday. Before all this kicked off, Brent crude closed at a pretty calm $72 and change per barrel. But then, Monday morning hit. The price didn't just climb, it exploded, gapping up to around $82 right at the open. I mean, this massive jump just reflects the immediate financial panic and the deep uncertainty that's now gripping the energy sector. This wasn't just a little blip. We are talking about the largest single surge in 4 years. And get this, the trading volume on West Texas Intermediate crude was over 1,000% heavier than average. That's not a typo. The market is absolutely reacting first and asking questions later. And it's not just knee-jerk panic from traders. The big banks, the heavy hitters, are now seriously considering a triple-digit oil price. You've got firms like Citi and Goldman already bumping up their near-term forecasts. But then you have others like Woodmac and Bloomberg Economics, and they're modeling worst-case scenarios where prices could hit $100 or maybe even $108 per barrel if that Strait of Hormuz stays blocked. So with all this uncertainty, what happens? Well, this geopolitical shock has triggered a classic market reaction. When risk skyrockets like this, investors dump their risky assets and they rush to so-called safe havens. So where did all the capital run? Well, they run to the usual suspects, right? The tried and true assets that investors trust during a crisis. We're talking about the US dollar, the Japanese yen, the Swiss franc, of course precious metals like gold, and government bonds like US treasuries. And the data, it absolutely confirms this flight to safety. The US dollar index is up significantly, which means the euro is falling against it. Gold futures have jumped over 3%, and investors are piling into government bonds, which pushes their prices up and, as a result, sends their yields down. Classic risk-off move. Now, how did all of this impact the stock market? As you can probably guess, this broad risk-off sentiment has punished equities globally, but the pain wasn't felt equally everywhere. What we're seeing is a classic market rotation. Money is pouring out of the big indices, like the S&P 500 and NASDAQ futures. They're deep in the red. Same with Asia's Hang Seng Tech Index. But that money is flowing into specific sectors that could actually benefit from this crisis. Think defense stocks, energy producers, shipping companies, and gold miners. They're all catching a bid. So the crucial point here is that market sentiment is now extremely fragile. As Jason Lee from BNP Paribas put it, investors are just trying to figure out if this is a short-lived shock or the beginning of a prolonged crisis. The duration, that is the key unknown right now. So to understand what might come next, we've got to keep our eyes glued to the upcoming economic calendar. These data points are going to give us the first real clues about the health of the economy in the middle of this energy shock. Specifically, we're all going to be watching the high-importance manufacturing PMI data coming out of both the Eurozone and the US. Why? Because these numbers will be the first major indicators of how the industrial economy is actually reacting to this spike in energy prices and the potential disruption to supply chains. And that leaves us with a critical question for the weeks ahead. This geopolitical shock isn't just about the price of oil. It's about its potential to reignite inflation. A sustained period of high energy prices could put central banks, who were really hoping to start easing policy, in a very difficult position. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.